And he chose to get paid not in salary. And if we look at the tax benefit from this, it's because you are taxed not on your income. That's not what the tax code says. You are taxed based on your taxable income. So now whatever you accountant, every smart accountant, not every smart accountant is going to focus on reducing your taxable income. And so what Elon Musk did is when he was building Tesla, he negotiated with the investors and the board that I want to get paid not with a salary, I want to get paid with stock options. A stock option gives you the right to buy that stock. And he was awarded these Tesla stock options at about $6 a share, which means if the Tesla stock goes up to $7 a share, he could sell the stock option for $6 and profit $1 for each stock option. Now, he was given millions and millions and millions of these stock options. And so now when the Tesla stock goes up to $100 a share, now he is rich on paper. He doesn't have any money in his bank. He hasn't gotten a salary, so he has no taxable income because he hasn't actually received any money. He has the option to sell this stock for $6 and in return get $100, so net $94. But if he sold that stock, he would have $94 of income. Now you have a tax because you have taxable income. So instead what he does is he goes to the bank and he says, hey bank, I have these millions and millions of stock options that are worth billions of dollars. Would you like to loan me $1 million, $10 million, $100 million at 3, 4, or 5% interest? No bank is going to say no because the collateral is so valuable.
What's the collateral?
The collateral is the company. It's his assets, those stock options.
Which is Tesla in this.
Which is Tesla in this instance. So then he gets, let's call it a $10 million loan from the bank. Now he has $10 million in his bank account, but it's not an income. It's debt. Debt is not taxed. If you go out and get a mortgage for $500,000, you're not taxed. If you do a cash out refinance, you're not taxed because that's debt. So now he gets this $10 million of loans that he can spend to buy a house, to buy a car, to buy food, to buy vacations, to buy whatever you want.
To buy Twitter.
To buy Twitter and pay no money in taxes. And it's 100% legal. Now you're going to say, well, Jaspreet, how does he pay it back? Well, let's just assume that you're going to get a 5% interest on this. If the value of Tesla goes up by, say, 7%, he made a profit. So now he can go back to the bank and say, how about you give me an additional $10 million? And he can pay back the old loan because the value keeps going up. And as long as the value keeps going up, no problem. But you can start to see where this gets risky. Because if Tesla goes bankrupt, now we're talking about a house of cards that can collapse. And now you have all this debt that you've already spent and no more collateral.
But in his case, he could, if Tesla starts to fall in value, then the bank will call payment. So if it, say it might be, I don't know, Tesla falls from, let's say, $100 to $10 a share, they're going to call payment. He's going to get, what's that called? He's going to get a...
margin call.
A margin call, which means that they're going to say, give me the money back quick.
Yes.
Or they're going to sell off the asset and to get their money back quick.
And it's a losing transaction. The bank will lose because banks do not profit from margin calls. Because once you start making margin calls, that's when panic hits.
Yeah.
And now you have to scramble to sell. And now the bank is just trying to get pennies back out of every dollar that they lent out.